So hello guys and welcome again to my channel, and we are on the step 10 of the accounting cycle, which is the last step. So that is what do we call as making reversing entries. Okay. So there is a dedicated video to this one because I guess I have to explain it deeply. Okay? So if you're new to my channel, so you can check on the comment section, there is a pinned comment there which which includes a link of the whole playlist of this particular series that I have developed. So this is based on a comprehensive problem called BBG Company. Okay, so if you wanted to look at the comprehensive problem that is featured in this series, as well as the step 1 up to step 9, you can go and click that particular link, or you could go to my YouTube channel and select playlist and then select from zero to hero, from zero to accounting hero, if I'm not mistaken. So let's have the reversing entries. Okay, so the reversing entries, the first question that we need to answer is, what is this? So I guess the simple explanation is that there are entries that you have to reverse. And how to reverse? Of course, if the entry to be reversed has a debit, you have to credit it. Just credit it. And then, if the original entry has a credit, you have to debit it. That's as simple as that. So that's how you make some reversing entries. Okay? As to why do we need reversing entries, you have to tune in the last parts of this video so that I could explain. Okay? So that's how you make reversing entries. The question is, what are those entries? What are those entries that should be reversed? There are only four entries. So, first one, I'd like to tell you that these are adjusting entries. What are the entries to be reversed? Adjusting entries, of course. But not all. Not all. Okay? So these are the adjusting entries for BBG company. So some of it will be reversed, some of it will not be reversed. Okay? So what are those entries that will be reversed? First off, the depreciation and the doubtful accounts expense related entries will not be reversed. So what will be reversed? Number one, accrued expenses. Number two, accrued revenues. Number three, deferred expenses adjustment. I would like to make it clear that the adjusting entries are the only ones reversed. So deferred expenses adjusting entry using expense method only. So if you remembered, our deferred expenses can be accounted for using asset method or expense method, right? So if the company chooses expense method, the adjusting entry at the year end or the end of the period are the ones reversed. So if the company is using asset method in recognizing deferred expenses, the adjusting entry will not be reversed anymore. Again, as to why, I'm going to explain that later. Okay? So, of course, the number 4 is the deferred revenues adjusting entry using revenue method. So, meaning, if the company Deferred revenues are usually advance collections from customers. So you did not yet give any services or any goods, the customer immediately paid you, even if you have not performed your part yet, right? So those are deferred revenues. And if you remembered, there are two methods of recognizing these deferred revenues. We have the liability method because it's your liability because you have not performed any but you are paid, okay? And we have also revenue method. So if the company chooses to use liability method, the adjusting entry will not be reversed anymore. Okay? So these are all the four adjusting entries that needs to be reversed. Again, accrued expenses, accrued revenues, deferred expenses, adjusting entry, but those only adjusting entries when the company is using expense method. And deferred revenues, adjusting entry only if the company is using revenue method. Okay? So, how do we do that specifically? For example, on the accrued revenues, for example, accrued expenses, if ever on December of this year, 20x1, so the December 15 to 31 was not yet paid, 20x1. So you have to have an accrued expenses adjustment, right? Like for example, salaries, expense, and then salaries payable, right? So that's your entry. Now, at the very beginning of the next year, which is 1/1/20x2, you have to reverse it. So salaries payable and then salaries expense. That's it. That's how you reverse. And another question was answered because of this illustration, which is, when are you going to reverse the adjusting entries enumerated here? The answer is on the January 1 or the beginning of the next year. January 1 if the company is following the calendar year period, which is January 1 to December 31. Okay? Now, if the company is following fiscal period, then it's much better if we say that the reversing entries are to be scheduled on the first day of the next period. Okay? So, that's how you reverse the entries. So again, these are the entries. When should be the entry? The reversing entry should be made. And of course, how to do that. Okay? So, the next question is, why do we make reversing entries? So, that's the question. Okay? So, we make these reversing entries. It would be easier if we will have some illustrations. Okay? So, again, as of this point, we have answered what are those entries that should be reversed, how should reversing entries be done, and when should reversing entries be made. So now, let's answer why. Let's have the first one, the accrued expenses. So, again, 12, 15 to 31, salaries of the employees, for example, has not yet been paid. So, on December 31, 20x1, you have to make an adjusting entry for the accrued expense. Let's say, for example, that salaries expense, 1 million, and then salaries payable, 1 million. Actually, guys, the reversing entry is only optional. Okay? It's optional, just like the preparation of the worksheet. Why? Because, for example, If in January 10, 20x2, the salaries of the employees from 12/15 to 12/31, 20x1 will be paid already. So if you can remember that you have accrued such, then your entry on 110/20x2 is just salaries payable. How much? 1 million and then cash. That's it. So, there is no accounting problem right there. It is because the salaries expense was recognized in the proper period in 20x1. And even if it's paid in January 10, 20x2, as you can see, it was not recognized as expense there. Okay? So there is no problem with that. So the problem with this one, if we're not going to use the reversing entry, what if you forgot that you have this entry in 20x1? Okay? So if you forgot, then your entry will not be like this. Your entry will be salaries, expense, credit, cash. Right? So this is the danger. Because if you forgot that you have accrued salaries expense on 20x1, you will double the recognition of your salaries expense. So, you have recognized salaries expense in 20x1. So, even if the salaries expense, you will say, Sir, we have closed that one already to the capital. Still, I'm so sorry. Still, you have recognized that and it affected the capital. Okay? So, again, the danger is this will happen. You have recognized it in 20x1. You have also recognized that in 20x2. Okay? Now, imagine, you have a lot of accrued expenses. Some of which you have accrued, some of them was not accrued. Okay? There are a lot of accruals that you have made related to accrued expenses. Could you remember all of them? Of course, sometimes you cannot remember all of them. So, normally, you will have expense credit cash on the next year or on the next period, right? So, this is the use of your reversing entry. For example, salaries expense, salaries payable, you have accrued that and you forgot about that. However, it's your practice to make reversing entries. Of course, what will happen is you will reverse this. So, let's go to usage of reversing entries. So, on 12/31, 20x1, you have accrued salaries, expense, 1 million, salaries, payable, 1 million. Okay? So, since you don't like memorizing what are those accrued expenses or accrued revenues um, that you have accrued, okay? That you have recorded, that you have recognized at year end. So you are using reversing entry. So what will happen? You have to debit salaries payable. Because you have credited it here, so to reverse that, you have to debit the salaries payable and you have to credit salaries expense. So that's the reversing entry. Now let's say the payment of the salaries came on January 10. So this is on January 1, 20x2. On January 10, even if you have not memorized those things that you have accrued in the last year, at the end of the year, and that you are going to pay 1 million salaries, even if you record the normal entry that you are making whenever you pay some salaries expense 1 million, and then cash 1 million. The salaries expense that you have recorded on 110 has been closed because of the reversing entry. In effect, the salaries expense is recognized only in 20x1 And in 20x2, although you tried to recognize a salaries expense for the second time, it was contradicted by your reversing entry, making your entries correct still. Because if we're going to eliminate the salaries expense, the entry is salaries payable, credit cash. The same with this one, which is the correct one. Okay? So that's the use of your reversing entries. So even if you have paid some salaries, normally your entry is salaries expense, credit cash. Even if you do that, even if you do not consider what was accrued at the year end of the previous period, you will still arrive at the correct entry because your reversing entry helped you. Okay? So that's the use of your accrued expenses reversing entries. Okay? Now, if you don't understand, let's have examples also for the other four. So we have the accrued expenses already, and I'm hoping that you did understand the purpose of reversing entries for accrued expenses. Let's go now with accrued revenues. So what is the normal entry when it comes to revenues? If you have collected some payment from your customer, of course, that's debit cash, right? And then credit revenues. So you wanted it to be like that, okay? So if you wanted it to be like that, you have to use reversing entries. So let me illustrate. Like for example, on 12/31/20x1, you have delivered goods. You have delivered your services already to a customer. However, he or she is to pay on 1/5/20x2. So what will happen? So without using reversing entries, you will have as an adjustment on 12/31/20x1, the moment that you have given already your services or goods, you will have accounts receivable and then credit revenue. Because we're talking about now accrued revenues. Okay? So, you have 500,000 receivable and revenue 500,000. Again, without using reversing entry, you can do that because reversing entries are only optional. So, without reversing entry, you have to remember this particular accrual that you made in the past year because when you collect that on 1/5/20x2, your entry should be cash, credit, accounts receivable, 500,000. Okay? So you can do that one. Again, you can not. You have the option not to use the reversing entries if you can remember all of the accrued revenues that you did on the past year. Okay? So if you have remembered this, then you can do this. So the revenue was recognized in 20x1 as it should. Okay? However, if you forgot about that, of course, your entry will not be like this. Your entry will be cash 500,000 and then credit revenues, which is a bad thing because your financial statements will then be wrong as to the balances. It is because you have recognized the revenue in two periods, 20x1 and 20x2. Okay? So, in order for this not to happen, even if you forgot your, what do we call this, accrued revenues in the past year, reversing entries can be used, in which what will happen is, on the adjustment here, if you have this, even if you forget about this entry, and you make a reversing entry on 1/1/20x2, which is um, debit revenue, 500,000, and then credit AR, 500,000, on 1/5/20x2, even if your entry is just debit cash, because you have collected the 500,000 from the customer. And then credit revenue, you'll still arrive at the correct entry. So again, this should be the correct entry. Okay? This is the wrong entry. But when using reversing entries, this wrong entry will now be correct. It is because the revenue that you have credited here will be offsetted because of the reversing entries. So if that's the case, the revenue was recognized in 20x1 as it should be, and there are no revenues recognized in 20x2, it is because the delivery of your goods and services happened on 20x1. Okay? So that's it for accrued revenues. Now, let's go to deferred expenses using expense method. So let's, what do we call this? Let's have a deeper understanding. Why is it necessary to have reversing entries when we're talking about adjustments for deferred expenses using expense method? Okay? So, first, let's have a review on the adjustment for deferred expenses. Deferred expenses are those expenses that you have paid in advance before incurring it, or you have pre-payments. So you are advanced in paying. Okay? Pre-payments. Now, let's have an illustration. As I've said, for example, this is October 1, 20x1, and you have paid for advance 12 months rent. No, 12 months rent, and that on this 12 months rent, that's 10,000 per month, and your year end is on 12/31, 20x1. So what will happen? Right? So there are no reversing entries yet. Let's talk about what will happen. So again, you have the option to recognize this as asset method, whereby your advance payment of 12 times 10,000 will be recognized first as an asset known as prepaid rent. So we have 12 times 10,000, 120,000. And then credit cash, 120,000. And then, at the end of the year, since there are 3 months that has already passed, of course, you have to recognize rent expense for 3 months, which is 3 times 10,000, that's 30,000. And then, you have to credit the prepaid rent for 30,000. That's it. So if you are going to have the asset method, you recognize the advance payment as asset first, and then at the end of the year or at the end of the period, you have to recognize the expired or the expensed. Okay? So every year, it should be like that. Right? So meaning, if we extend this analysis to 20x2, so on 12/31, 20x2, you have to make an adjustment, right? Because on 12/31, 20x1, let's use this also as 1/1, 20x2, because 12/31, 20x1 and 1/1, 20x2 in analysis in accounting is usually the same because they are only 1 day apart. So on 12/1, 12/1, on 1/1, 20x2 or 12/31, 20x1, you will have a prepaid rent balance of 120 minus 30 because 30 has already expired. So you still have 90,000. Right? So that 90,000 on 12/31, 20x2, there will be no problem. It is because you just have to recognize rent expense. right? So that's 90,000, and then prepaid rent will be credited. So why did I say there is no problem? It is because it is consistent with the asset method. We have asset first, and then at the end, we have to recognize the expense. Okay? On 20x2 also, we have an asset first, although it's only 90,000. And at the end of the year, we have to recognize the expense portion. So, there will be no reversing entries. There will be no use of reversing entries right here in the asset method because it is consistent. Asset first, and then recognize expense at the year end. And then on 20x2, asset first, and then recognize expense at the end of the year. So it's consistent. Sir, what will happen if we are using expense method? If we are using expense method, guys, supposedly, the pattern is first, we have to recognize everything as expense. So that expense 120,000. Okay? And then after that, you have to credit cash also 120,000. Now, on 12/31/20x1, you have to recognize the unexpired. And in this case, the unexpired is 90,000 because the only ones expired is the 30,000. So you have to recognize prepaid rent. How much? 90,000. And then you have to deduct rent expense 90,000. So there will be a prepaid rent already here at 90,000 on 1/1/20x2 at the beginning of the year. So that's what will happen. It's expensed first. The overall is expensed first. And then you recognize the unexpired or unexpensed at the year end. So that's how expense method works. Expense, and then at the year end, unexpensed or the unexpired. You have to recognize the unexpired. So without reversing entry, what will happen? We have prepaid rent here. So meaning, it started as an asset already. And then you have to recognize the rent expense at the end of the year, 90,000, and then credit prepaid rent, 90,000. Can you see the pattern right there? It was broken. Supposedly, it should be rent expense and then the unexpired at the year end will be recognized. Again, the pattern for expense method, recognize the expense immediately. Alright? And then at the end of the year, you have to adjust for the unexpired portion. Okay? But on year 2, it did not happen. Why? Because we have the prepaid rent already at the very beginning. So it became an asset method. And actually, it's very much the same with the asset method right here. Prepaid rent, 90,000, and then it was expensed at the end of the year. It was expensed at the end of the year. This is not expense method. This is an asset method. You recognize first the asset at January 1, 20x2. It is because of this adjusting entry that this prepaid rent came to be on 1/1/20x2. So asset and then expense. This is not really the pattern for expense method. Again, the pattern should be expense, and then at the end of the year, you recognize the unexpired. Okay? Expense, then recognize the unexpired at the year end. It did not happen here. Okay? So, how do we correct this so that on 20x1, you use expense method. On 20x2, you also use expense method by using reversing entries. In which, if this is the case here, what will happen is we'll erase this. Since we have an adjusting entry, this is the adjusting entry at 12/31. So on 1/1/20x2, if you reverse that, you have rent expense. And then you have to credit prepaid rent, 90,000. This will be canceled out already. And it starts now as an expense on January 1, 20X2, which should be the pattern. Okay? So, expense first, and then you recognize the unexpired at the end of the year. But in this case, since everything has already been expensed, because from 1/1/20X2 to 12/31/20X2, the 9 months, the 90,000, has already been expensed, there will be no adjusting entry. Okay? So because of the reversing entry, this one, from expense method, and then there is an adjustment, it became an asset method, it will be reverted back to expense method. So expense and expired. So do we need reversing entries for deferred expenses using expense method? The answer is yes. So that the pattern for the expense method will be preserved. And again, the pattern is expense first, everything, and then the unexpired will be adjusted at year end. Okay? And if there is no reversing entry, and this happens, your expense method on the next year will be converted into asset method. So you are already contradicting your policy if the company is choosing to use expense method. Okay? So that is also the same with the deferred revenues. But still, I will discuss this. So, how about deferred revenues? I'm sorry, my voice is a little bit, what do we call this? Harsh. Harsh? Horse? Horse. Not horse like an animal. Horse. It's because I have a cough right now. Still, let's do this. So deferred revenues are advance payments from customers. Like for example, if a customer has paid you for 30 months, yeah, 30 months. No. Let's have this at 15 months. No, 18 months. Paid for your services 18 months in advance. And it paid, for example, 10,000 for simplicity. And today is October 1, 20X1. For simplicity again. Now again, if there is an advance payment from the customers, the company can choose to recognize this as liability method or revenue method. So, when it comes to liability method, this will happen. First, you'll have to recognize the debit cash because you have received something from the customers, and that is 180,000. If I'm not mistaken, that's 180,000. Yeah, 180,000. And you recognize it as an earned service revenue. However, at the end of the year, you have to recognize what was earned. And what was earned is for 3 months. So that means unearned service revenues will be deducted by 10,000 times 3 months, which is 30,000. And then we have service revenues of 30,000. So because of that, the unearned service revenue remaining is 150,000, which is the ending balance for 20X1, and also the January 1, 20X1 balance, 20X2, January 1, 20X2, or the beginning of the year 2 balance. Okay? So is there a problem with that? No. We can extend our analysis to 12/31/20X2. So on this unearned service revenues, 12 months has passed also. So that means the adjusting entry for this particular transaction is unearned service revenue 120,000, and then credit service revenue 120,000, bringing the unearned service revenue to 30,000 only. Okay? So is there a problem with that? No. So you don't need reversing entries because the pattern is followed using liability method, which is you recognize everything, the cash advances from customers as liability first, which happened here. And then you have to recognize at year end the earned. Okay? So meaning unearned first, everything, and then you recognize the earned at the end of the year, which happened here. Of course, in 20x2, that pattern is still unchanged. Why? You start with the unearned, which is 150,000 only here. Because again, the 30,000 was earned already in 20x1. This is the unearned. At the end of the year, you recognize the earned. So unearned, and then the earned, unearned, and then the earned. So the pattern is basically similar or the same. Okay, so there's no problem with that. Okay, the only problem is when you use the revenue method. Why? It is because on the first year, you recognize this immediately as revenues, 180, and then 180. But at the end of the year, you have to recognize the unexpired, which is the unexpired or the unearned. Is unearned service revenues 115. You have to recognize that, and you have to deduct your revenues as 150 also. So the pattern is just like that on the revenue method. Revenue, all of it will be recognized as revenue first, and then the unearned will be recognized at year end. So that's the pattern. Let's see if that pattern will still be the same if we do not use reversing entries on the year 2. Okay? So what will happen? Your unearned service revenue right here on 1/1/20x2 will be established. If that's the case, since it has been established and you are not using any reversing entry, you will be forced to recognize the earned portion on 12/31/20x2. So the earned portion is 120. So your entry will be unearned service revenue 120,000 and then service revenue 120,000, bringing the balance into unearned service revenues 30,000. And as you can see, that's very similar to what happened on the liability method, which is not the pattern for revenue method. Okay? So in here, revenues first, and then the unearned is recognized at the year end. Okay? But it is not already true with 20x2 because you started with the unearned here. And then you recognize the earned. Okay? So, that happened because you did not use the reversing entry. If you use the reversing entry, this will happen. That this is correct. Revenues, and then the unearned. So, this is the balance. So, we have to reverse. You use reversing entry. So, we have to reverse this adjustment. So, unearned service revenues, 150,000. And then credit revenues, 150,000. So if that's the case, this will be cancelled because of this entry. And now we're back to revenue method. It's because the whole 150,000 became revenue. And when adjusting, of course, since this is all revenues, your adjustment will not be like this because this is an adjustment for liability method. Your adjustment will be unearned service revenue 30,000 and then service revenues 30,000, which is already parallel to what should be the entries for revenue method, which is revenues at first and you recognize the unearned at the year end. So this happened right here in year 2. Revenues at first and you recognize the unearned at year end. Okay? That is why reversing entries are needed for deferred revenues under revenue method. So the adjustment should be reversed so that the revenue method can continue on the next periods. Because if not, your revenue method will now be converted into liability method like what happened in this one before this reversing entry. So I hope you understand. So that's it for reversing entries and step 10. So in this particular adjustments of Baby G company, which of this should be reversed? Of course, the adjustment number 1 is not to be reversed because this is an adjustment of a deferred expense using asset method. Because what you recognize at the end is the expense part. So this will not be reversed. Not reversed. Of course, the number 2, the supplies, is the same with number 1, not to be reversed. Because the supplies, if you can still remember our comprehensive problem, is recognized first as an asset, and then we recognize the expired portion at the end of the year, which is this one. So it's not to be reversed. The depreciation should not be reversed. Okay? But the salaries expense and salaries payable should be reversed because that is an accrued expense. And on the accrued expense and accrued revenues, there are no methods. There are no expense method. There's nothing like that. There is only one adjusting entry, which is expense payable for the accrued expenses. It should be reversed. If you understood our discussion, you know that it should be reversed. And this number 5 should also be reversed. Right? And of course, the number 6, the unearned revenue and the service revenue, as you can see here, this is a deferred revenue using liability method. Okay? Because what was recognized here is the earned portion. If the entry is just like this, the earned portion has been recognized. So if earned portion is being recognized, that means the company is using liability method. This should be the entry if ever that is a revenue method. Service revenue debit, unearned service revenue credit. So it should be, what do you call this? Reversed. If this is reversed, then the company is using revenue method. But in our case, if you remembered our comprehensive problem, we did not use the revenue method. So not to be reversed. Okay? So that's it. However, let me tell you that in problems, sometimes the expense method, the revenue method, liability method, they are not explicitly or expressed or directly expressed in problems. So you have to see it sometimes using signs. Like for example, you are given an adjusted trial balance and your unadjusted trial balance there in the problem reports rent expense, for example, but the prepaid rent is 0. So that means the company is using expense method right there. Because that is still unadjusted, so there are no adjustments yet. Yet, your rent expense is already positive and the prepaid rent is 0. So maybe the company is using expense method when it comes to deferred expenses. And if you can see a big service revenue on the unadjusted trial balance. Again, unadjusted trial balance are balances of the T accounts or the ledger before adjustments, right? And if you can see already some service revenues who is bloated, and there is unearned service revenue in the unadjusted trial balance, but the amount is 0, then maybe the company is using revenue method. So if that's the case, you have to treat it using revenue method and using expense method. So that's it for the accounting cycle for service entities. I am hoping that we are going to go to the next level, which is on the merchandising aspect. Still, we're going to have the accounting cycle step 1 to step 10, and we are going to have a comprehensive problem also, so that you will see the step 1 to 10 of the accounting cycle for merchandising entities. So that's it for this video, and I hope you learned. And if you do, please click like, subscribe, and hit the notification bell, and share this video to those who need it, your classmates or people who wanted to understand the accounting cycle. You're more welcome to share this. So thank you again, and see you on the next one.